Hi everyone, this is Mrs. Wee Chen. Welcome to my Form 5 Accounting Lesson 5. And today is 25th of February 2020. And we are going to do one DSE question on admission of a new partner. Okay, alright, so this is the question we are going to do. Now here we have Chu and Yang. Okay, and later on, here, on 1st January, Mac was admitted as a new partner. All right, so let's do some revision here. Okay, and also you can draw this diagram about the admission. So before we have Chu and Yang, we have two partners, they are all partners, and now we are going to have three partners, Chu, Yang, and Mac. So this is the date for admission of Mac. Okay, and then do you remember whenever we have admission, we always have three things to do. The first one is capital introduced by Mac, and then we need to do goodwill adjustments because the profit and loss ratio changed, and we also need to do revaluation of assets. Okay, and after that, look at the things that we have to do in this question. So there are two parts. One is to draw up revaluation accounts, and one is to draw up capital accounts in columnar form. All right, so since there are three partners, and then we are going to give three columns on each side of the capital account. Now here, part 1, revaluation accounts. All right, and part 2. So this is the capital account with three partners. Okay. Okay, so let's look at the question. In point number 2, we have this. Goodwill was to be valued at 150,000, and seeing that no goodwill account was to be maintained, so this is method 2. Okay, means we don't open a goodwill account. Actually, this method is better because this goodwill generated internally is too subjective. So if we use method number 2, we need to draw up a table like this. Okay, now let's look at the diagram again. So these two are the old partners and they share this ratio in the old time, and after admission of Mac, and this is a new ratio, and this is date for admission, and goodwill is equal to 150,000 because on this date it is no longer a baby firm, no longer a new firm, so there is goodwill established. Okay, so since this is method 2, we don't open goodwill accounts, we need to drop the table. Remember, you have learned that in the previous lesson. Okay, so old ratio and Mac is not here, and this is new ratio, and this is the total goodwill. Okay, so Mac is not here, so then I need to use calculator to share this goodwill. 150,000 divided by 5 times 3, so that 90,000 goes to Chu, so minus 150,000, so 60,000 goes to Yang. Okay, and then if we use new ratio to share the goodwill divided by 6, so this is 25,000 for Mac and times 2, that is 50 for Yang, and then 25 times 3, that will be 75. Okay, now we make comparison by using both old ratio and new ratio, and don't forget who established this goodwill. It must be the old partners. All right, so that Chu should get 90,000. Right after changing profit and loss ratio, Chu gets a loss. All right, so I use a bracket for the loss, and Chu lost 90 minus 75, so that is 15,000, which is not fair to Chu. And Yang should get 60, but right after doing nothing and changing the profit and loss ratio, Yang also get a loss of 10,000, which is also not fair to Yang. And then you look at Mac. Mac should share nothing for goodwill, but now Mac has a gain of 25,000. Okay, so since this is no goodwill account open, therefore all adjustment related to goodwill will be done in the partner's capital account. Therefore, we debit the gain. So who gained? 25,000. So that is MAC. Capital MAC by 25,000. Okay, and credit the loss to compensate those who lost to get a loss 15,000, and then credit capital, which is Yam, because Yam also get a loss just by doing nothing. So therefore, this is the adjustment using the capital account for adjustment of goodwill, since we don't open goodwill accounts. Okay, then let us do posting about adjustment of goodwill. So here is my capital accounts, and we start with this opening balance given to us for Chu and Yam. All right, and then you can see MAC is not here yet. So here I have opening balance to begin with for Chu and Yam. Now the posting is here. So debit capital MAC. So MAC is here, so I debit 25,000. And the description is goodwill. Okay, posting. All right, and here credit Chu and credit Yam. 15,000 goes to Chu and 10,000 goes to Yam. Okay, and the description is also goodwill adjustments. Okay, so next we come to point number 3 about revaluation of assets. Now here, property is going to be changed to 2,020,000. So now you need to make comparison and look at the original value 782, so that you can see this figure is understated. Therefore, how do we change? We need to increase the property by the difference. So how do we increase property? Property is a debit item, so therefore we debit property and then credit revaluation account by the difference. So 202 minus 782. Okay, so to increase this by 1,248,000, so that, and then I have the same amounts. Okay, and next look at inventory. Inventory 266,000. This is the old value, and now we have to change it to this much. And you can see the new value is lower than that, so we need to decrease inventory. So credit inventory to decrease inventory and debit the evaluation account by the difference. So that would be 2666 minus 133 and 200. So that would be 133,400 and 133,400. Okay, so this is a double entry for point number 2. Now I'm going to do posting. So here, debit property to increase the value of property, and credit revaluation. Here, this is credit side. So credit this by 1,238,000. Okay, because of property. So again, you can see this side is positive. All right. Okay, now here, debit revaluation 133,400 because of inventory. And this is negative side. Okay, and then we have a special thing here. Point number 4, an allowance for doubtful debts of 1% was to be made. Now this is special thing. Now very often we make allowance for doubtful debts in the profit and loss account, in the income statement. Okay, but since this is, the adjustment here is related to admission, so that we don't bother the profit and loss account, we use revaluation account instead. And what is allowance? Allowance is a credit item, so therefore if we have to provide it, we credit allowance for doubtful debts. Okay, and debit revaluation account. You can see to create allowance for doubtful debts, which is also a bad thing. So that will be 1% on trade receivable here. Okay, all right, so I need to debit revaluation account. So here is my revaluation account, because allowance for doubtful debts, and the calculation is how much is receivable. Trade receivable is 230,000 So here my calculation is 230,000 times 1%. So that would be, I cancel 20 here. So that would be 2300. So 2,300. Okay, we just do double entry step by step. Okay, and point number 5, which is also a special thing. So we have these professional fees were paid in cash for the revaluation of assets. Okay, so now we have revaluation, remember, in point number 3. So why we have this in order to be more objective and free from bias? Okay, we get consultation from professional here, okay, to reevaluate the assets to make it more accurate, so that we have to pay these expenses. Point number 5. Okay, in the normal situation, professional fees would be a kind of expenses in the income statement, but now since this is related to the activity of admission, therefore we don't bother the income statement. However, we charge this in the revaluation accounts, and therefore pay in cash. We have to credit cash by this much. Okay, so this is it. And after the double entry here, I do posting again. So debit revaluation, so I have 26,200 here because of cash accounts. What for? The description is for professional fees. Okay. Okay, so finally, after we have made all the adjustment in the revaluation account, so I'm going to close it. So to close it, this side is bigger, so 1,238,000. And also here I put 1,238,000. Of course, I have to insert things here. Okay, so since credit side is bigger, so we add things here. So that will be gain on revaluation. And then we always use capital account to do this. But be very, very careful. So who's going to share this gain on revaluation? It should be always the old partners. Okay, so always the old partners to share. So these two are the old partners, Chu and Yan. So I have Chu, I have Yan. Okay, and they share in 322, so that is 3/5 and 2/5. Okay, now this is very, very important. Who's going to share the gain on revaluation? It must be the old partners. Okay, so this is how we close the revaluation account. Since credit side is larger, so we have a gain on revaluation. And gain on revaluation is a good thing to the partners. So therefore, I'm going to put this on credit side. This is positive to partners. So that will be 2, 645, 660, and 430, 440, and nothing to the new partner because it should be the old partners to share. Okay, so that will be revaluation accounts. Okay, so this is revaluation account. This is the pair of the double entry. Okay, let's check what we have done so far for admission of a new partner. We should always have 3 things to do. We have now done goodwill adjustments. We have finished revaluation of assets. Now we come to admission of Mac. So Mac is the new partner, so Mac must bring in capital, right, for admission. But in this question, this is the very special thing here in this question. So point number 6. Okay, it is saying that initial capital of the new partnership. Now look at this new partnership, and here is my capital account. All right, so this is balance brought down with Mac. Mac is not here yet, so that means this balance is not yet the new partnership. So where's the new partnership? Here is the new partnership. When we get the closing balance and when we finish all the adjustments, so the total here should be same as this much. Okay, and then we're going to share in this ratio according to the information given to us. Okay, so this is how the three partners share this initial capital in this ratio given to us. So the closing balance here after all the adjustment will be 600,000 for Chu and 525,000 for Yam and 375,000 for Yam. However, if you look at all these double entries, okay, the answer is not possible to be equal to this. Therefore, if you go back to the question, we have the last sentence here saying any surplus or deficits will be adjusted through partners' injection or withdrawal of cash. And now let me explain what is the meaning of this point to you. Okay, so first, let's look at Chu's column. So now we only have 600 on debit side, but however, the total here is 1,440,660. So therefore, we have to insert something here in order to close T. Okay, and the amount to do that will be 765,600 in order to make it balance. Okay, so and nothing here on for Chu's column. So what is the meaning of this? That means obviously Chu has a debit balance or credit balance. So credit side bigger. So credit balance. Okay, so which is a surplus. So there is a surplus to Chu. So that therefore we should pay back money to Chu in order to make the surplus down to 600,000 by paying cash and debit capital for Chu by 765,600. You okay? So therefore, when we close the T column for Chu, so we work out cash in this way. So this is the balancing figure, and that which is debit capital for Chu and credit cash, because we are going to pay cash to Chu, and because Chu got a surplus in his accounts like that. Okay, now we come to close Yam's account. So Yam has 525,000 on debit side, and then this much on credit side. So obviously, debit side is bigger than credit side. Therefore, we need to insert this much on credit side because debit side is bigger, credit side is smaller. So we say that there is a debit balance in Yam's account, and the opposite of surplus is deficits. Therefore, this time Yam has to pay money to the firm, so that the firm is going to receive cash, and then we credit capital Yam's account by 39,560, 39,560. And why we get this figure, it is also from the T account. It is also from the T account here, and then we call this as balancing figure. Okay, now finally we come to Mac's column. So Mac has 25,000 and 375,000 on debit side. However, nothing on the credit side. So to close it, we put total 400 here. Okay, so therefore, finally, this is 400,000 being inserted on credit side, and which is cash, and which is the balancing figure from the T account here. So insert on credit side, that means credit side is smaller. So therefore, what do you think? So Mac also has a debit balance, which is a deficit. So this time, Mac has to bring money to the business by cash. So we receive cash, the firm receive cash, and credit capital Mac. Now be very careful. This figure is not given to us in the question. All right. However, we need to work out this as balancing figure from the current account here. Okay. So let's go back to the diagram here. So we have done goodwill adjustment, we have done revaluation, and the very special thing for admission of Mac, that means Mac has to introduce capital because Mac is a new partner. Okay, and the double entry is debit cash and credit capital for Mac, and this is very special thing. However, the figure given to us is not given, but we know that from the balancing figure, this is the amount that Mac has to bring into the business. And how do we get this 400,000? It will be the balancing figure here in balancing figure here in the column of Mac, which is exactly refer to the meaning of point number 7, and this is the meaning of any surplus or deficit will be adjusted by taking money and drawing money or giving money to the firm as cash. All right, so this is a very special point in this question. Okay, all right, and this is it. So thank you for watching my video. I'll see you next time. Bye bye.